Here's a clear snapshot of why investors are seeing pullbacks in memory related names like Micron, Western Digital, SanDisk, and Seagate, even amid long term AI demand growth. 1. Profit taking and momentum exhaustion. After a massive run tied to AI memory demand, many memory stocks soared into early 2026, some by 500% plus in 2025, before spinning off or resetting, like SNDK. That sharp advance created short term overbought conditions, leading traders to take profits and rotate into cheaper or next in line tech stocks. This kind of pullback after a momentum surge is very typical. 2. Broader market and macro headwinds. Tech stocks in general have faced pressure due to rising bond yields, market volatility, and risk off sentiment, which tends to hit high beta names like memory more than broader indices. 3. Analyst downgrades and valuation concerns. Some analysts recently cut ratings or tempered expectations on MU, citing that valuations had gotten stretched to peak multiples, creating downside risk even if earnings stay solid. 4. Competitive dynamics and product cycles. On the tech front, reports suggest that Samsung is accelerating HBM4 production, which may pressure Micron's share in the fastest growing segment of AI memory. That uncertainty around future share gains, especially in HBM, can weigh on stock performance. 5. Underlying memory market complexity. Despite price spikes in DRAM and NAND, the memory business remains cyclical, and contract pricing often leads actual semiconductor revenues by months. Investors can get spooked by any signs of slowing OEM orders or hints that hyperscalers may tighten forecasts. Historical memory cycles have overshot on the upside, only to swing sharply once inventory catches up. 6. Divergence between prices and earnings. Even while spot prices for DDR5, NAND, and other categories continue to climb, real demand and manufacturing lead times are lagging. That means pricing power doesn't instantly convert to higher sales or margins for the companies, at least not within a quarter or two. This dynamic often triggers short term corrections. Key takeaway: memory stocks are down not because AI demand has disappeared, but because short term traders are locking in huge gains after big rallies, valuations have gotten expensive relative to near term fundamentals, competitive dynamics and product transitions like HBM4 are creating uncertainty, and macro tech sell offs have hit cyclical or high beta stocks hardest. In other words, the longer term AI memory thesis can still hold, but short term price action is being driven by sentiment swings, rotation, and cyclical risks, rather than a collapse in structural demand.